2024 has just begun, and after several years of heightened macro and market volatility, we are all hoping for a smoother ride in the new year. However, uncertainties abound and might bring as many surprises as in 2023. 2023 was a year that truly defied expectations. The US economy was supposed to barely grow, but in reality, growth will likely hit 2.3% to 2.5%. Similarly, with the post-COVID economic reopening, forecasters expected strong GDP growth in China. But in fact, macro data proved to be weaker than expected, particularly in the property sector. And more generally, across countries, inflation surprised to the downside. So, bearing in mind the lessons learned last year, how do we see 2024? It seems to us that all stars are aligning towards weaker US economic growth. We believe that corporate earnings at the national level will be under growing pressure over the year, leading to labor cost reduction and eventually to higher rates of unemployment. Meanwhile, we believe inflation will continue to recede and converge towards levels more acceptable to the Fed, thanks to the rebalancing of labor supply and demand and the subsequent slowdown in wage growth. We are also of the view that the US will avoid a hard landing, thanks to the meaningful cushion provided by already elevated fiscal deficits, around 6% of GDP, and a considerable amount of cash held by households and businesses, a legacy of the COVID stimulus. With weaker inflation and higher unemployment, the Fed will likely ease monetary policy. We believe 100 basis points to 125 basis points of rate cuts in 2024 would be necessary to provide the right signal to the economy, with further cuts in 2025. In China, we expect 2024 to be a year of transition, with further progress in the restructuring of the property sector and more targeted support to local governments to deal with lower tax revenues and non-performing assets. Deleveraging the economy while consumers remain cautious is a real challenge that will likely put a lid on growth between 4.5% and 5%.
"2023 was a year of surprises and wild swings in markets. Bond markets remained in a state of unusually high volatility throughout the year. Despite this, DM equities staged a strong recovery, and they did so against a litany of headwinds, such as global central banks' aggressive policy tightening, US bank blow-ups early in the year, and unfavorable geopolitics. In contrast, Asian equities disappointed, although this was largely driven by weakness in Chinese equities, with pretty wide dispersion across other local markets. As we go into 2024, some of last year's macro uncertainty is likely to stay with us, at least initially, but we believe the outlook for markets should brighten as the year goes on. As developed market economic growth is set to slow early in the year and valuations are somewhat stretched, investors should be prepared for the possibility of a rocky start to the year for equities. But in our view, this is likely to represent a buying opportunity. Key for this view is the likely behavior of the US Federal Reserve. History shows that the beginning of a US Fed interest rate cutting cycle is a bullish signal leading to strong equity market gains, unless it is followed by an outright US recession, and that is something which we believe is unlikely this time around. Furthermore, after the recent aggressive hiking cycle, the Fed now has plenty of rate cut ammunition. We believe these combined factors are likely to reassure investors that any macro-induced weakness in equities early on in the year is likely to prove short-lived. Continuing positive news from the technology and AI space could be another positive driver for global equities. We also expect 2024 to be a better year for Asian equities after the recent run of disappointment. First, fundamentally, valuations for the region remain quite attractive. And second, as the US Fed cuts interest rates, this should further weaken the US dollar and give more space for Asian central banks, in turn, to support their economies if needed. This set of conditions tends to be favorable for Asian equities to outperform their DM counterparts. Last but not least, after a disappointing 2023, Chinese equities look attractively valued to us, and investors' expectations for the asset class are now quite modest. If Chinese equities can build on these factors to stage even a modest recovery, that could be a further boost to the Asia region's equity performance.